Hello everyone, myself Namita Suresh Madi and my presentation topic name is Types of Financial Model. What is a financial model? Financial modeling is a representation is a number of a company's operation in the past, present and the forecasted future. Such models are intended to be used as a decision making tools. Company executive might use them to estimate the cost and project the profit of a proposed new project. It is a risk management tool for analyzing various financial and economic scenarios and also provided evaluation of assets. This model involves calculations, analyzing them, and then provide recommendation based on the information gathered. Types of financial models: comparative company analysis model, sum of the part models, discounted cash flow model, merger and acquisition model, leverage buyout model, option pricing model. First, comparative company analysis model. Comparable company analysis is a process used to evaluate the value of company using the matrices of other business of similar size in the same industry. Comparable company analysis operates under the assumption that similar companies will have a similar valuation multipliers. Also referred to as the comparable or comps. It is the one of the major company valuation analysis that is used in the investment banking industry. In this method, we undertake a peer group analysis under which we compare the financial metrics of a company against similar firms in the industry. Sum of the parts model. Sum of the parts valuation is a process of valuing company by determining what its aggregate division would be worth if they were spun off or acquired by another company. The equity value is then derived by adjusting the company's net debt and other non-operating assets and expenses. It is also referred to as the breakup analysis. This modeling involves valuation of a company by determining the value of its division if they are broken down and spun off or they were acquired by another company. Discounted cash flow model. The discounted cash flow model is a way estimating the present value of an asset based on its stream of future cash flow. The model relies on the concept of the time value of money, whereby a dollar paid in the future is less valuable than a dollar today. DCF. Discounted cash flow is based upon the theory that the value of a business is the sum of its expected future free cash flow discounted at an appropriate rate. Investor particularly use this method in order to evaluate the potential of an investment and estimated the absolute value of the company. Merger and acquisition model. A merger occurs when two separate entities combine forces to create a new joint organization. Meanwhile, the acquisition refers to the takeover of one entity by another. Merger and acquisition may be completely to expand a company's reach or gain market share in an attempt to create shareholder value. The entire objective of merger modeling is to show client the impact of acquisition to the acquired equity per share and how the new equity per share compare with the status. In a simple word, who will say the new equity per share is higher, the transaction will be called assertive, while the opposite will be called dilative. Option price model. Option pricing model are theories that can calculate the value of an option contract based on the number of variables within the actual contract. The key aim of a pricing model is to work out the probability of whether the option is in the money or out of the money when it's exercised. Option traders tend to utilize different option price model to set a current theoretical value. Option price model use certain fixed known in the present and also forecast for factor like implied volatility to compute the theoretical value for a specific option at a certain point in time. Leverage but out model. And leverage but out model is a financial tool typical built in Excel to evaluate a leverage buyout transaction, which is the acquisition of a company that is funded using a significant amount of debt. Both the assets of a company being acquired and those of the acquiring company are used as a collateral for the financing. Leverage buyout deal involves acquiring another company using a significant amount of borrowed fund to meet the acquisition cost. This kind of model is being used majority in a leverage finance at a bulk bracket investment banks and sponsors like the private equity firm who want to acquire companies with an objective of selling them in the future at profit. Thank you.